Have you ever tried to organize an event? You have to keep track of registrants, accept payments, and make sure everyone is reminded to show up on time. Sounds like a lot of work, no? Well, Reggie Agarwal had that problem over 20 years ago, and he was trying to organize everything using Outlook and Excel. There had to be a better way. Well, there was. Reggie created new software to help organize events, and that software is Cvent. Here we are over 20 years later, and Cvent just sold to Blackstone and ADIA, the Abu Dhabi Investment Authority, for over $4.5 billion. In our July 2023 video newsletter, which you should subscribe to in the link in the description below if you don't already receive it, we took a deep dive into the Cvent deal, and we're happy to share it with you here. So stay tuned for our Mink Sites video newsletter. In this edition of Mink Sites, we will walk you through the Cvent deal, a recent deal where Blackstone is acquiring Cvent to bring the company private. We'll go through the history of Cvent, followed by the details of the deal, and then we will analyze the deal. So let's get started with the history of Cvent. Back in 1999, Reggie Agarwal was working as a lawyer full-time. On the side, he started an association called the Indian CEO High Tech Council, where Reggie would organize quite a few networking events for tech CEOs in Washington, D.C. To manage, market, and organize these events, Reggie was using Excel and Outlook. There had to be a better way. Well, Reggie did come up with a better way, and that was creating software, Cvent. And that's how the company was started. Cvent grew rapidly in 2000 when it raised $17 million from many investors, including CEOs of AOL, Bell Atlantic, and Nortel. This was during the dot-com boom, so those companies were doing fairly well at the time. With that new funding, Cvent went from 6 employees to approximately 125 employees. Well, as you know, the dot-com bust happened soon after, and Cvent crashed as well. It had to fire 80% of its employees and was on the verge of bankruptcy. Well, Reggie and his core team did not give up, and Cvent turned into quite the success story for many to learn from. Cvent grinded it out over many years and made many new improvements to Cvent's offerings, including in 2008 when Cvent launched the Cvent Supplier Network, a marketplace that connects venues and meeting planners. 50,000 venues were added to the network after the first year it was launched. And in 2011, Cvent raised $136 million in funding, led by New Enterprise Associates and Insight Venture Partners, to fuel global growth organically and through acquisitions. In 2013, Cvent went public through an IPO. At the time, it was an iconic moment for the company, but it would be short-lived. In 2016, Vista Equity Partners, the large software-focused US-based private equity firm, brought Cvent private through an all-cash deal that valued the company at approximately $1.65 billion. After Vista acquired Cvent, Vista merged Cvent with another company it owned called Lanyon, and the resulting firm would continue under the Cvent name with Reggie acting as the combined CEO. In 2019, Cvent acquired Wedding Spot, a wedding venue sourcing platform, and acquired Double Dutch, a player in the mobile event app industry. In 2021, Cvent entered the public markets one more time. This time, it was not through an IPO. It was through the merger with a SPAC, a special purpose acquisition company, with Dragoneer, in a deal that valued Cvent at approximately $5.3 billion. In 2023, at the time of the deal we are talking about in this video, Cvent had approximately 22,000 customers globally, had managed over 5 million events up to that point, and had listed over 300,000 hotels and venues on the Cvent supplier network. So let's move on to the details of the deal. Blackstone, along with the wholly owned subsidiary of ADIA, the Abu Dhabi Investment Authority, brought Cvent private again in a deal that valued the company at approximately $4.6 billion. At the time of the deal, Vista Equity Partners was the majority stockholder of Cvent, and for the deal, agreed to invest a portion of its proceeds to help finance the transaction. So let's analyze the deal. Well, let's look at the stock chart of Cvent from when it went public in 2021 through the SPAC until when Cvent publicly accepted the Blackstone offer on March 14th, 2023. Does this look familiar? Well, if you subscribe to this video newsletter, which you probably do if you're watching this right now, you'll remember that last month we talked about the Qualtrics deal, where in 2021, when Qualtrics went public, it was valued at approximately $27 billion. And then in 2023, Qualtrics was valued at approximately $12.5 billion. You don't have to be good at math to realize that $12.5 billion is a lot less than $27 billion. As you can see with Cvent, in 2021, the company was worth approximately $5.3 billion, and in 2023, the company was worth approximately $4.6 billion. Now, keep in mind that for both deals, since they were both brought private by a private equity firm, the private equity firm paid a premium to the stock price, so the stock actually fell a lot more than the values were shown. Now, Cvent's decline is not as big as Qualtrics' decline, but one could argue that it was caused by the same reason, the inflated values of tech companies in 2021. Now, for the analysis of this video, I want to focus on something else for Cvent. I want to talk specifically about early stage companies. In 1999, when Cvent was started, the market for all internet-based companies was hot. Cvent was able to raise $17 million in its first year, and Cvent hired over 100 new employees using that money. Now, while raising money to grow too quickly happened a lot for tech companies in the dot-com bubble, it has happened many, many times since then, although it's slowed down quite a bit in 2023. I struggle to understand why young companies use their number of employees as a measure of success. Investors, when you are looking to invest in early stage companies, here are 7 important things to look for outside of how many employees a company has or how many employees the company wants to hire. Number 1, the problem. What problem is the company solving? Number 2 is the solution. How does that company solve the problem? Number 3 is the market. Is there anybody that has this problem and needs or will buy this solution? Number 4, the business model. How is the company planning to make money? Through recurring revenue, one-time revenue? Number 5, the traction. Does the company have any sales or even any sales orders? Number 6, the team. Who are the people that are going to make this happen? One of my favorite parts of a company presentation is when the company adds up all of the years of experience of its team members. And then it says something like, we have over 70 years of combined experience to try to impress investors with a big number. And number 7, the financials. When looking at the financials, we want to figure out the actual details, not just look at the hockey stick shaped graph that every company will show you. So investors, when you are looking to invest in an early stage company, look at the problem, solution, market, business model, traction, team, and financials to figure out if the company is a good private equity investment.